Welcome back to another episode of Fund Friday with a recurring guest, maybe one of the most popular guests that we've had on the show, a friend to, of course, myself, but to Lone Star Capital, a partner. Welcome, Gib Irons, back on the show. How are you today, my friend?
Craig, I'm doing great. Doing great. Life is good. A beautiful sunny day here in Eastern North Carolina. And man, life is good. Always good to be on the show and always good to spend time with you.
Yeah, likewise. Well, just first things first, was everything okay following the hurricane that obviously came through about a couple weeks ago?
Yeah, so Craig, I live in the eastern part of the state, and we're fine. The western part of the state got hit really hard, and you know, friends of ours like our good friend Bryce Robertson over in Asheville, and Chris Larson, and all those guys. They had it a lot worse than we did. Honestly, the East Coast normally gets hit by hurricanes. If there's a hurricane, it's normally on the coastal areas, but this time, Hurricane Helene went inland, and it created a massive amount of flooding. And really, the word I've heard is that the place was obliterated, like
Washed
Asheville,
away.
Boone. Yeah, all those places have been really bad. And I spoke to a good friend of ours today. Catherine Bell was on my podcast earlier today, and she told me that what they wanted and what they needed was they wanted food, fuel, um, water, and body bags is what they needed. Really, really needed help with, and that's I'm not being funny or facetious. Like
Yeah.
those are really the things that these folks needed, and so it's been a catastrophic event, and I just hate it for them. We've got a lot of friends that are struggling right now, but hopefully they're getting some much needed aid right now. And I know, like Catherine, for example, had put together a group of people that they raised like $100,000 in 48 hours and
Wow.
sent a bunch of supplies in to that area by helicopter. And so a local company that had access to helicopters, flew in all those supplies that they purchased, but they raised over $100,000 in 48 hours and sent some much needed supplies. But yeah, it's been tough on those folks, and those folks are. It didn't affect us, but those folks are our neighbors, and so it affected us in that way. That we're talking about people 4 or 5 hours from us.
Which is crazy that North Carolina is, in fact, a 4 or 5 hour driving state. Being from California, you think that's the only really state that's that big, but nuts nevertheless. But happy to hear that you weren't affected. But just to that point, our friend Chris Larson has an incredible GoFundMe where he is legitimately kind of in a sniper position, if you will, from his house, kind of coordinating, efforts from here. He's got everyone from Green Berets to friends like Lone Star Capital to Gib Irons kind of helping the donation effort. So if you do have a couple dollars to spare there, it goes a long way. All of our friends in Nashville and those who were affected from Milton and Helene, you are, of course, in our thoughts. I just want to start there, make sure everything's good. But on to the show. On a more fun conversation topic, let's get into what's kind of happened. You're on the show about a year ago. I actually checked it was about 8-9 months ago, but a lot's changed since then. We've had a lot of economic impact going on. We're in the middle of an election. We had the hurricanes going on, a rate cut. So there's a ton to unpack here today, particularly with you. But let's just go over maybe some of the things that you've learned over the last year that maybe have kind of come up, that maybe have reshaped your philosophy or just, overall strategy, perhaps.
Yeah, no, that sounds great. Let's do it.
Yeah. So what are you currently raising for right now? What is getting you excited? I mean, I know of course, we've been fortunate enough to raise with you, but is there anything else that you're kind of working on as well that you've had your ear to?
Yeah, so last time I was on the show, I think we talked a little bit about 10Y, and I'm pleased to report that 10Y, was a build to rent townhouse community fund that we were doing in the Phoenix, Arizona area, right there out in your neck of the woods. I know you spend a good portion of your time in Phoenix, and I think it's kind of like your central headquarters, even though you travel as much as anybody I know. But we have done really good with that fund. So we started out with about 13 capital allocators, and we have almost raised $30 million for the fund. We had like a first tranche that was called Zenit Thomas, and that was just one singular townhouse community. And Zenit Thomas is now under construction. We're working on vertical construction there. Our raise for that one was 18.5 million. And now we're raising for, this larger 10-year fund where we're going to spread our investment out amongst a bunch of different townhouse communities. And so inside of that fund, we're very close to having raised $30 million. We will be closing out the fund on November 29th. So right at the end of November, we're going to close out that fund. That's been fantastic, Craig. I've raised about $3 million for the 10Y organization. And
Congratulations.
yeah, thank you. It was awesome, an awesome experience because I had plenty of time to work on that raise. I had over a year to raise that money, which really helped. As you mentioned, you and I have done 2 deals recently. I worked with you on Grand Riviera, which was in Dallas, Texas. And then I worked with you on Cortland Med Center, which was in Houston. And both of those opportunities are beautiful opportunities. I loved the dynamic for Grand Riviera because we were looking at a 3-year hold. And it seems like we've gotten even better news, after closing. Things have really started to click into place, and the returns look better than what we had expected. I know right before we closed on Grand Riviera, the debt market started to change, and we started to see a decrease in interest rates. So I know we ended up locking in at a lower interest rate, which boosted returns. And you were sharing some stuff with me recently about other things that could boost the returns. I don't know if that's public information for dissemination.
Not yet. Yeah, it's not yet. So I appreciate you teasing that, but I love that you're kind of whispering and dancing on the line of what's allowed and not. But it is very accretive, and actually, it's kind of funny about positive momentum. And this is some of the beauty that you get when you work in the market, and you kind of keep buying. There's some times where things are working against you, which has kind of been the theme over the last 2 years with debt kind of going higher. And then there's circumstances where stuff is actually working for you. And what we had working for us were actually organic rent growth and the debt market getting better, which both those things really juice up the cash on cash return. And of course, the overall value to the property. And then we have this wild card kind of in the background there that is very exciting, which if you want to email me or Gib, we can share more accordingly.
Yeah, it's super exciting to see a deal that you're already really happy with it and you're proud of it and you're like, okay, this is going to be exciting. My investors are going to love this. And then to see things improve in the way that they did, because that's not always the case, right? And so with this particular deal, we got a better debt. Our debt structure ended up being a lot better than what we anticipated. We ended up pivoting and locking in a lower interest rate. And things had just gone really good with the takeover. So, I had a blast at the Lone Star Summit. I got to meet a lot of the people that are your boots on the ground Lone Star team, the property managers, all the people really focusing on asset management. And it just is very encouraging how things have gone with that takeover. Cortland was a fantastic raise. Gosh, that one, we had a lot of really good capital allocator partners that came into that one, and we filled it up very quickly, which...
Well, and it's kind of funny, Gib, not only did you fill it up quickly, but you got an email from me, which is so funny. Rob and I were joking about this just prior to the summit, which was, Craig, you've got one of the very few positions where I'm actually paying you to raise less money on this deal. Because to your point, and similar to Grand Riviera, but the debt actually started working in our direction again, where debt actually became more attractive. We could take out better proceeds, max proceeds, take out higher LTC than what we initially projected. And because of that, we were able to raise less money, which actually juices up the returns, because the more leverage you take, the higher or the better or worse your deal could do, if it does bad, if it does well. So leverage is an X factor there. But with the going in DSCR and that deal being so accretive and attractive going in, that's why we can take out more leverage with the tax exemption program on that deal.
Yeah, the tax exemption program is so cool. And I think, it really speaks to me because we're essentially saving a tremendous amount of money on taxes through a tax exemption or a tax abatement. And by saving, and then in exchange for that, we're lowering the rent on 50% of the units, right? And so, and I know you can speak to like the rent reductions and how that works, but we have 50% of the units are reduced rent, but at the same time we're boosting NOI. I think it was like 29% on Cortland Med Center. We boosted NOI by 29% on day one of the investment just by locking in that tax abatement.
Yeah, and then on top of that as well, not only do you get a nice setup, you get the benefit, the investors get the benefit, but what is also, I would argue, the most important part of this aspect is the mission-driven ability where we're able to preserve affordable housing in economically very difficult times with all the hardship going on from inflation really wiping people out. The cost of a dollar has really gotten diminished, which is why we're having these conversations today, why we want to educate all of our investors to get there. But it's a win-win-win. Public benefit is served naturally. Our investors will get, a nice healthy return. And then, there's nice housing for folks who really need it the most, kind of the backbone to the country and the economy, which is, a lot of these kind of more blue collar workers that are super crucial that, need nice, safe housing and good school districts and good school areas. So that's really nice. But the interesting thing about those two deals, just contextualize them, is that how different they are. Not only are they in difficult geographical areas, but they're different business plans and different vintages. So was that something that, when you went to your investors, you noticed there was a difference between the two deals that we raised for, in the sense that they are different on the spectrum of business plans?
Yeah, I think they're very, they're not totally opposite, because you've got so many different types of deals out there, right? I mean, if you compare a multifamily value add deal to a build to rent deal, that's very different. If you talk about a mobile home park, that's very different. And so just having, a different vintage is still a multifamily, proposition, right? It's still a multifamily deal. But I did find that some of my investors love the 3-year hold aspect of Grand Riviera, because if you're a new investor and you really haven't invested a lot in a multifamily syndication, you may be a little bit hesitant to have your money illiquid for a long period of time. And so the investors that don't want to do a 5-year hold or a 7-year hold or a 10-year hold seem to really gravitate to, okay, this is cool. Like, I had a lot of people that were brand new investors and had never invested in a syndication come into Grand Riviera, and they felt very comfortable with that 3-year hold. And a lot of people like an older 1972 vintage. They actually want to come in and do a bunch of CapEx and see. Grand Riviera had a bunch of classic units with original finishes, and that gives you a tremendous opportunity to increase rents after doing, a pretty drastic uplift on the property. And I think our CapEx budget was what, like $20,000 per unit on Grand
Yeah.
Riviera, which is that's a big chunk of change.
Yeah, no, without a doubt. So essentially, the makeup of that deal is so different, to your point, to the kind of Cortland Vizcaya, or sorry, Cortland Copperleaf. That's another one. But Cortland Med Center. I'm going all the Cortland deals going crazy here. But Cortland Med
There's
Center.
a lot of them. Yeah, there's a lot of them.
Exactly. So Cortland Med Center, the acquisition we just did with you, was basically fully turnkey. With the tax exemption on it, then the deal was done, the strategy was done. But with Grand Riviera, we basically budgeted about $20,000 to $22,000 per door on the CapEx. So that was about $12,000 to $15,000 on the interiors that we're talking about here. And then we also have, the budget for the exteriors on that property, with the foundation, with the paint, with the curb appeal, and then also the amenities. So I think a lot of investors really do like seeing that before and after picture. Now, I'm pretty agnostic where the returns come from. As long as I'm solving for that kind of mid-teen return, I don't really care too much about what it looks like, but it's great to offer people geographical diversity, which you've kind of done with the 3 raises. If you think about it, you've done the 10Y, which is in Phoenix, and that's a build to rent, not as much cash flow there, I would assume. And then you've got the Grand Riviera deal, which is older vintage, but really nice value add, below replacement costs, and arguably the best market. And then you've got Cortland Med Center, which was in Houston, a tax exemption deal, affordable strategy play. Three wildly different kind of deal types that you've kind of raised for.
Yeah, they are totally different. And I think that's important, right? Because you want to diversify your portfolio, not just from different asset classes, but within an asset class, you want to diversify. And so, I like having the BTR play. I think the build to rent deal, the 10Y Rise deal, has a tremendous amount of upside, but it's ground up development. And so there's a lot of risk with ground up development that you don't encounter in a value add proposition. And so I like the potential upside in 10Y, but I do, caution my investors that when you're doing ground up construction, you're inevitably subject to a lot more risk because you've got construction delays, you've got to deal with a general contractor, you've got to acquire the properties. Just acquiring land is a risky proposition. And so I think, 10Y, I think it's relatively low risk when you compare it to some of the other asset classes out there, like investing in Bitcoin or meme coin or whatever, all the different
Exactly. Miscellaneous cryptocurrencies and such.
Yeah, look, I mean, I know some guys that have made a fortune doing it. I had a guest on my podcast a few weeks ago, and he's got over $10 million in his crypto account, and he's made a tremendous amount of money from it. But I would say that's much more speculative than what we're doing. But 10Y was more of like a high risk, high reward type thing within the multifamily sector, relatively speaking. And I feel like Grand Riviera was your straight down the fairway value add proposition. I mean, we may be able to supercharge those returns, and we may end up, exceeding our projections by a long margin. But I just don't feel like there's as much risk there. We're in a great submarket. We're in Irving, Texas, Las Colinas area. There's not a lot of land right in that area, and the place is super built out. And so we don't have that concern of somebody coming and building another property right across the street. Whereas in Phoenix, like, we're literally building across the street from, like, Neil Bawa is literally on the other corner, across the street from us. And that's okay because, we knew that going into it. But, and then Cortland having the tax exemption, I think that really speaks to the ingenuity of Lone Star Capital. Lone Star Capital finds ways to make money in times when other people are saying that you just can't make money in this market. And that creative genius is why I love working with you, and why I, am such a huge supporter of the deals that you have done. That took a lot of creative ingenuity. And now what have you done? 12? I think, you've partnered with the housing authority like 12 times, maybe more.
For sure. And it's kind of one of our niches to, create a good opportunity and create win-win-wins, which is super, big to us, not just for the economic benefit, but from being a good partner with the city during difficult times. I think it's just something that we can't stress enough, is that crucial component of doing a good service and doing well for our investors, the tenants, and everyone inclusive. So if we can kind of engineer those returns in that sense, that's obviously very beneficial. But it's exciting there, and we want to keep kind of doing unique structures and whatnot. To your point, which I'm someone as yourself, from the law aspect of things, I'm sure you of all people can appreciate the nuances there.
Yeah, I do. And Craig, I remember you came on my podcast. I don't remember exactly when it was, but my show, Go Big with Gib, you came on the show at one point, and we talked about your goals for 2024. And so one thing I'd be curious, you talked about how much property Lone Star wanted to acquire, and you said it in the context of, look, it's not all about just acquisitions. Like, we want to bring great deals to our investors, and that's the real bottom line here. But where are you tracking in terms of those goals that you had? I mean, it seems to me, looking at it from the deals we've done together, that you guys have got to be right on track with your goals. I know you guys set very lofty goals, but gosh, you guys have you've really had a lot of a deal flow and activity this year.
Yeah, that's a great question, and thank you for asking. I would say I think our goal was either 200 million or 250 million coming into 2024,
That
and I
sounds
think we'll
right.
be a fraction shy of 200 million with our latest deal that will be coming out soon. I think at this point the deal will be out, so email me if you're looking for more information on that. But we are going to be at about 200 or just shy of 200 million this year, which frankly is really awesome considering how slow things have been. So our goal is that, and I think for 2025 our goal to kind of go around the corner there is to really kind of change what we're looking for. So we had a lower minimum in the sense that we would do deals kind of below 30 million before. And then
Hmm.
Rob even said this year, hey, no deals under 30 unless it's a unicorn. We found some deals that were really compelling where it made sense. But I think for 2025, even, we're going to try to do no more than 6 deals. So, basically one every 2 months effectively, plus or minus, depending on, the time of year. But 6 raises and have the
Yep.
minimum or have the deal size be around 50 million per with a minimum below 40 with rare exceptions. And if we had one below 40, the goal would be to bundle that deal with another deal and kind of do a dual raise like we did for the Houston 3 property portfolio.
Yeah, that makes total sense. So it sounds like you guys are tracking well in a very difficult economic climate. You're tracking pretty close to your goal, which is amazing. I
And it's
mean,
not easy right now. And that's the thing with I'm so impressed by you is within a very relatively quick period of time, being able to successfully raise on 2 of our deals plus the 10Y opportunity. So with that said, I guess to flip it back to you, what are some of
yeah,
the biggest lessons that you've learned with capital raising over the year? What has maybe been easier than expected and what's maybe been harder than expected?
yeah. So I think, one of the things that's really, really critical. I mean, first of all, people are very hesitant to come off their money right now. People are scared. It is an election year, as you mentioned earlier in the introduction. We're sitting here in the middle of October of 2024, and we've got an election coming up here just in a few weeks, and there's a lot of fear in the market. Regardless of political affiliation, whether you're a Democrat or Republican or whatever, there's just a lot of fear right now in the economy. And so, one thing I've learned is that if you can raise in this environment and be successful in this environment, and if you can get deals done in this environment, then you're going to be able to really thrive when the market changes, right? Because real estate is cyclical, just like anything else. Anybody that tells you like we're always going to make a bunch of money in real estate, that's a lie. I would say that there's probably some way to make money in real estate, but it's not always going to be the same game plan is going to work in every different type of economic cycle. And so we've been experiencing a very difficult economic cycle, and I think that people that are able to survive, and do and flourish in this environment are going to do very, very well. So that's one point, Craig. Another thing is like really keeping, really listening to my investors and what do they want to invest in? What is their risk tolerance? What are their goals? I think that's more important now than ever because there are so many people trying to syndicate deals. And if you're comparing me to just another person without knowing without knowing me personally, um, I really need to understand what it is that they want so I can bring them those kind of deals. I will tell you that one thing I'm getting ready to work on is I'm going to do a medical real estate fund, and it's going to be triple net leases, medical real estate. The first thing we're going to do is we're going to acquire 2 buildings, and one of them is in Pennsylvania. The other one is in Arizona, in Tucson, Arizona. And these are medical buildings that are occupied by like dentists, veterinarians, doctors, all types of different medical establishments. And I'm really excited about that because, one of the things with multifamily that is, more difficult is dealing with these residential tenants, and here we're going to have long 10 to 15 year triple net lease arrangements where essentially the tenant is responsible for everything. And they're responsible for the taxes. They're responsible for the insurance. They're responsible for the maintenance. And so our margins are better because we don't have any cost. And so I think that's a very attractive offer in this current economic environment. And, candidly, that's a little bit of a pivot from what I've done with the BTR space and the multifamily value add, but it's still within the same category. And I still think it'll
Well,
speak to my investor base.
Well, I think it's really smart and interesting as well. So let's just kind of break down the fundamentals there of what you're doing. So the BTR and the multifamily, that is housing, right? Fully makes
Yes.
sense. So the
Yes.
medical stuff is also interesting though, because unlike traditional office, well, you're in maybe your home office. I'm in my home office right now. This is my office moving forward. Now, naturally, we've got World Trade Center office space, of course, but the world is shifting and changing. But one thing that will not change, although office will shift, is you need a brick and mortar store to go to the doctor. You need it for any sorts of specialization for the veterinarian, so on and so forth. So I think that's a really interesting play that you're talking about here, Gib. The more I think about it, is that is a window into something that is, very essential. Health, stuff like that. That's not going anywhere anytime soon. Was that kind of part of your thesis there when you kind of identified that opportunity?
Yeah. So it totally was that, healthcare is an essential thing. Like, we just went through COVID where everybody had to shut down unless you were deemed to be an essential, provider of goods or services.
Yeah,
And
and COVID didn't care, by the way, if you had a heart attack, if your dog was sick, if you got sick, if you got a sinus infection, if you needed to go to the dermatologist to get your skin checked, you needed to get those things done. That is incredibly essential, which I love you said it, just like shelter is essential.
exactly. So that definitely was part of our thesis that, we're underwriting these medical providers as if we were buying the business. And so the head fund manager, the head sponsor or the lead sponsor is a dentist, and his name is AJ Peak, and AJ has acquired a tremendous number of dental practices. So he basically started out as a clinical dentist doing dental procedures and whatnot, and he started acquiring other dental offices. And so through that process, he learned how to underwrite a dental practice. And so we are using those same underwriting skills when we consider a tenant to come into our building. We are underwriting the tenant as if we were going to acquire the business, when really all we're doing is, allowing them to lease our property and come in on a 10 to 15 year triple net lease where they're responsible for all the taxes, the insurance, the maintenance. But yeah, I mean, even in an economic downturn, those medical providers are still going to do well. And we're looking at all their financials. We're looking at their infrastructure. And we have AJ, who is, acquired so many dental practices in his career that he really knows how to underwrite them, look at the health and well-being of the organization and the likelihood of them being around 10 to 15 years from now. So it's a very safe investment and de-risked from that perspective.
Right. So let's talk about maybe some of the fundamentals here. And I guess, but actually, before we do that, let's take a pause. You having your law practice and whatnot, understanding the numbers of running a business and then working with another dentist doing that, does that kind of give you more confidence that this will be done with laser precision here and laser focus and very sharp? Because if you've run that before, you could probably look at a P&L and a rent roll and say, okay, well, that makes sense to cut down on this cost. Well, hey, you're kind of too ambitious here. How much does your background and working with someone else who also done that before give you confidence that this will be executed very well?
Yeah, so I think it's critical. I mean, AJ specifically has this skill set from acquiring all of these dental practices, and he was very fortunate in that he built, you know, this these groups of dental practices, and then he was able to sell off to private equity, and he was able to return huge amounts to his investors. So he had investors in these dental practice acquisitions, and those investors made a tremendous amount of money, like 7 to 8 times their investment. So, it's a tried and true operation. But yeah, as the managing partner of a law firm and a business owner myself, I understand how important it is, to have good economic factors in the firm. You don't want to have too much debt. You don't want to have too much salary. You want to have a certain percentage of your overhead to be salary, a certain percentage to be advertising, and other types of overhead. And like you learn those percentages. And so when we're looking at these medical providers that are going to be coming into our space, we're looking at all those metrics. And I think that is a tremendous benefit because, we're only taking the healthiest. We really can be very selective over who we work with. And a lot of these medical providers have, they're large corporations, and there's like corporate guarantees backing these practices. So it's
So
not just like a mom and pop operation coming in. It's like a big medical institution that could be in several different states, and they're going to give a corporate guarantee as it relates to the rent payment.
And that's probably really the value play there, is taking something where you're getting that, and then you have the guarantee of the corporate background to really ensure the safety of the tenancy moving forward. Because if you do unfortunately have maybe not an A-rated tenant, potentially more of a mom and pop, well, I think everyone here likes to support small businesses, of course, but from putting your investor hat on, if you can have a Starbucks be your triple net tenant, or a Chipotle or a Chick-fil-A, that would probably serve you well. So similarly, if you can kind of get a name brand in the medical space to kind of fill your building, that's kind of the equivalent, roughly, I would say, to what you're speaking to.
Yeah, exactly. I mean, it's the safest way to do it, right? You're dealing with known entities that have already been doing well for a long period of time, and just within the past short period of time, I don't know the exact timeline, but AJ has acquired like 7 different medical office buildings in 7 different states, and I would say that's probably like within the past 6 to 12 months, and so. That's a massive undertaking. And he's got all these relationships with brokers that will know when something's coming on the market. And so this just actually was like a very natural evolution from what he was doing in acquiring dental practices to now acquiring medical office space. And so we've got a couple of capital allocators that are already in the medical real estate space, which is pretty cool as well. So this is right down their alley. We've even got one physician that is helping us as a capital allocator, and so that's right up his alley, of course. And it's a great asset class to go into at this particular time. And like we said, I want to offer my investors some diversity, and this is exactly that.
Yeah. I have to imagine there's, like the Dr. Johnny Walkers of the world who probably would be interested in something like this. Comes to mind as he's done maybe more root canals than anyone else in the country, as a matter of fact, which is a crazy statistic to say the least. So he's been kind of doing stuff like that where you sell it at a compressed EBITDA. So with that said, just from an overall structuring perspective, do you basically raise this as an individual offering for investors, or are they investing into a pool of sorts where it might be a closed-end fund you're raising to a certain target, and then you're basically closing it up, and then 10 years later, you return capital 5 years later? Or is it a per deal basis? Can you kind of walk through that?
Yeah, so sure. So the first fund is going to be 2 medical offices, and that's fund number 1. We're going to raise about $3 million on that fund. And, we will probably release a different fund every quarter. So for the, for the first quarter of 2025, there will be one fund. It'll be a $3 million raise, and it'll be 2 medical office buildings, one in Pennsylvania and one in Arizona. Then we will open fund 2. And I mean, I have not committed to stay in for every single iteration of this, but I'm definitely going to be involved in fund 1, which is a $3 million raise. And we don't even really need that many capital partners, to raise $3 million.
I mean, you raised 3 million yourself on, the other deal, right? So you could probably come in and bring the bank guns out and take care of it. But naturally, maybe you want to spread it around. I could imagine, knowing you.
Yeah, I did well with that first raise, and so I hope to, have a repeat performance. But yeah, that's kind of how we're breaking it up. And so it'll be, the thought process though, Craig, is that after we get to over like 10 to $15 million in net operating income across all the properties and all the different funds, the thought process is that we could either sell to a buyer similar to ourselves, where it would be, a private buyer coming in and buying it, for cash flow reasons, because it's going to have an amazing amount of cash flow, right? This is going to spin off 8 to 10% cash on cash. We're looking at like a 15% IRR with our base case analysis. But there is the opportunity to sell to a REIT. And believe it or not, I didn't know this, but there's over 100 healthcare REITs out there right now in existence. And if we were able to sell to a healthcare REIT, then you could get cap rate compression where maybe we're buying everything at an 8 cap and we could potentially sell at like a 5 cap, because these REITs will pay a higher dollar value because they want to acquire all the properties at one time. And so by selling them off in a portfolio, we can, get cap rate compression and really capitalize. And if that were to occur, then we could be looking at a 20% IRR, maybe even 25 or 30% IRR. So right now, just the properties that AJ already owns, it's about 20 medical offices, and he's got about $2 million in net operating income. If we can get that to over 10 million, then we can start shopping it to healthcare REITs and probably sell it off by the time we get to about 15 million in net operating income. That would be a perfect time to sell to a REIT. And if we did that, it would be much bigger of a windfall to the investors than if we sold to a private buyer.
Right. And there's definitely some of that on our end too. Not saying that there's anything that we're speaking about privately at Lone Star, but there is a potential kind of thought in the back of the mind that, hey, since we do have so many properties in that affordable structure, there could be a potential buyer out there that would take the entire portfolio of those affordable deals, because it would be accretive to them, because they could say, okay, well, this is similar. Maybe they've got a mission-driven statement. Maybe it's a government, grant of sorts that will be acquiring these. Maybe the city of Houston buys it. We don't know. But taking the larger sum and selling it for a compressed rate is how you make a tremendous amount of cash. So that's something we think about. Of course, this is just what we're thinking. This is not investment advice, but this is generally speaking the strategies and the conversations that we're having with our investors, just to make that clear naturally there. But that's awesome. And I really do like that thought process there of kind of getting smart, taking something that's a little bit unique, maybe that has a little bit higher of a cap rate going in, but making it maybe potentially more compressed, but putting a really high level of expertise there. Naturally, the higher the cap rate is, the higher the cash on cash is. And as you mentioned, that medical office thing for a triple net lease there, being at that, high single digit number is really a great return there as a base case. So awesome to hear about that. Question for you, just at a holistic level, what are your investors looking for right now? I know you said you've asked them a lot of questions, you're listening very intently, but what are some of the things that you are seeking, or that they're seeking right now, that are getting them to invest? Are there certain concerns? Naturally, this is not the stock market, so it's a little bit different. These are generally speaking illiquid plays. So, what's kind of been your ear to the ground report?
Yeah, so I mean, I think different investors are looking for different things, right? But I've had the opportunity to work with a lot of new investors, and they love, deals like Grand Riviera, where we're doing a 3-year hold. I've got a lot of investors that have invested with people like Grant Cardone, and they've done deals with Grant that don't tend to yield as high of a return as what we get with some of the deals that I've done with Lone Star. And those guys are real interested in, they like doing a whole bunch of CapEx. I think people are really scared to come off of their money right now. I think there's just a lot of fear and uncertainty, and people want to see stability and track record. And I'm hearing that more and more than anything else. And another thing is, when you've got tough times, having really good reporting and really like all frequent cash flow distributions is super, super helpful. One of the things that my investors have liked the most about working with Lone Star and our partnership, which has been so effective, is the monthly reporting and the monthly cash flow distributions. Like, I don't care who you are or what you say. Like you can say it doesn't bother you or you don't care, or you don't need the cash flow. Like, let's be honest, if a deal is doing 5, 6, 7% cash flow, or even 8 or 10% cash flow, that's not going to change our lives, right? But psychologically, it gives you a really good feeling to know that the deal is performing well and that you're getting these periodic installments, even if it is, let's say it's the low end and it's a 5% cash on cash return. Psychologically, the investors like to see that. They want to see reporting. I think right now there's so much fear out there that, transparency is more important than ever. This was not a Lone Star deal, but I did have a deal that I invested in as a limited partner, and we had a building burn down. And it was in Dallas, Texas. It was a 1970s vintage property, and we had a fire. And, honestly, I had a tremendous amount of respect for that operator after the fire. I had more respect for them after the fire than before. So, in some ways, I'm glad that that building burned down. It was an unfortunate thing. Nobody was, injured or anything like that.
Also nicer to have a deal where you were the investor on that one, not the capital raiser, where you had to make some phone calls. It was just you.
Exactly. I mean, look, it was my money, and it made me nervous, right? But that operator reached out. They told us what was happening, and they did a really good job of putting things back together and getting people back into the properties. And now we're back at like 93% occupancy, something like that. And I mean, we lost a tremendous number of units. So we really took a big hit. But I think the investors really want that transparency right now. Give me the good news, give me the bad news, but just give it to me, and don't sugarcoat it. Tell me, what struggles we're having. Tell me what successes we're having. So I think more than ever, that transparency is super critical.
Good. Well, I'm happy to hear that. And that's certainly something on our end too that we stress on kind of in our introductory calls with any capital allocator or, LP, limited investor, passive investor is, three things that we kind of work on and focus on are transparency, communication, and focus. So the fact that we hit up our end of the bargain is great. And so far to your experience, so far so good, as they say. And on your end, the fact that you kind of had that as a takeaway where great learning lesson, they could have handled it really poorly, or they could have handled it like they did, and then also have a win from how they've kind of came back from that is even more impressive, arguably, is, I think, everyone handles good news well. That's when times are easy, but it's when things are more difficult. How do you stand on that? How do you let people know what's going on, the ebbs and flows? And that's really how you make it in the business, is not through the good times, but for the bad times. Because when everything's going well, you don't have to manage that well and still get an amazing return. You don't have to really try that hard to push a little bit harder because the tenant's willing to pay. But when times are like right now, when you really got to focus on the ABCs of real estate, collecting expenses, things of that nature, this is when you make a name for yourself. So bravo and hats off to that other operator who did a great job navigating the storm and the fire, quite literally.
Yeah, they did a great job of getting us back on track. And it built a lot of credibility with the investor base because we got a bunch of emails like, here's, photos of the property damage, and here's the issues we're having with the insurance company, and here's what we're going to do to remedy that. It was kind of like, I've heard people say, tell me what you know, tell me what you don't know, and tell me how you're going to bridge that gap, right? And I think that's what investors want. Like, give me the facts that you've got at your disposal. Tell me the things that you don't know yet that you're trying to figure out, and tell me how you're going to get there. And if you can do that, that'll build rapport with those folks to where they're more willing to come back and reinvest with you.
Yeah, I think Hunter Thompson tells this story all the time, which he was in a deal, and I think he might have mentioned actually at our summit, which, thank you so much for attending, which was I had a amazing or pretty good return, but the communication was awful. Therefore, I'm never going to work with them again. So it's such an interesting concept just for people to think about. And it totally makes sense. If the deal does well, but the communication was awful, you're going to think it was a bad deal. If the deal was okay, maybe not the best, but the communication was great, okay, hey, well, it wasn't a good deal, but maybe there's some things that are out of that sponsor's control, but they handled it with grace and class and dignity, if you will. So it's just so important how you handle these things. This at the end of the day is not just a widget business. This is a human element business. And sometimes sponsors are treated a bit like a commodity in a sense. But some of the soft skills and the bedside manner, as you know, as an attorney, are so crucial to have a good result.
Yeah. Yeah, bedside manner is so important, right? Like it's not just what you say, but it's how you convey the message. And and with that, bad news doesn't get any better with time. And
No,
as an attorney, I have to relay bad news to my clients all the time. And one of the things they pay me for is to shoot them straight and tell them, like, if I feel like a client cannot realistically prevail in their case, then I have to tell them that. If we've got things we've got to overcome and challenges that we've got to face to get them to where they need to be, then I have to tell them that. And it's the same thing with investors. And so, a lot of the skill set that I've developed over the past 18 years as an attorney has been super useful to my development as a capital allocator. That those same communication skills that enable me to be an effective attorney also work as a capital raiser in
I
dealing
would
with investors and building confidence.
I would argue that you can sit on good news, but you can't sit on bad news. Like if you have good news, you can just wait and tell people maybe it's not as urgent, but bad news is actually substantially more urgent and critical to disseminate when you do get it.
It really is. It really is. And I think people will be understanding. Like if you've had a delay, and if you're not able to close a deal and you have to delay closing, or if you've had some sort of fire or a natural disaster or an act of God, or if you're doing a ground up development project and it's not gone as quickly as you had projected, people deal with that so much better if you just tell them, look, we have not met our timelines thus far, and we're behind, and we recognize that, and this is what we're doing to change that moving forward. It's just so much better when the operator takes accountability for that and takes responsibility for it and says, look, I understand we didn't meet expectations on that part of it, but this is what we're doing to fix it, and just bear with me. People are a lot more gracious when you take that attitude. I do have deals, Craig, and I don't know if I've talked about this with you before, but I have one deal that I get like quarterly reporting. The reporting sometimes says almost nothing, and I'm a limited partner in the deal. I invested over 2 years ago, and I haven't seen one penny in cash flow distribution since I invested. And how disappointing is that? Like I'm over here wondering, what's going on with the deal? Did the property burn down? Is it still there? Is there, are we doing okay? Are we not doing okay? And I think, that experience has taught me a lot about communication because like Hunter said, I mean, even if that deal returns a good return, I still wouldn't do another deal with that particular operator. And thank God I was a limited partner on that deal. And thank God, that's part of the reason why I invested with Lone Star before I agreed to raise capital. Like, I made a sizable investment with that Houston 3-pack portfolio before, which was a a very sizable amount, a big chunk of change that I put in there, and everything went smoothly. And I was like, okay, now I have seen exactly how they operate. And it was just night and day from that other experience. But I have seen the good, bad, and the ugly.
Right. Well, no, thank you so much for the public display of your affection for Lone Star Capital here. Thank you so much for the kind words, but it's just a good lesson. And, I think what sets you up uniquely to be a great capital raiser is your experience of, you know, being in the day in and day out of actually feeling what it feels like to be an investor and to kind of put your own dollars in something and feel what you're supposed to feel and make those mistakes perhaps so your clients and your sphere of influence doesn't have to do that. You have kind of gone through this trial and error process of, wow, that was really great, or wow, that was really awful, and here's why. And that will probably shape your thesis moving forward to only make you smarter from a capital placement position.
Yeah, and Craig, my investors, they do their own due diligence, and I obviously recommend to them that they do their own due diligence. But I will say that I'm not going to raise for an opportunity if I don't truly believe it. So I've already done a tremendous amount of due diligence when I go into it. And I think they know that as well, which, that's the experience is the best teacher, right? I went out, I invested with a bunch of different operators. I saw those that handled things well. I saw those that did not handle things as well. And I learned just as much from the bad investments as I did from the good. It's an unpleasant experience, but that was part of becoming a capital allocator myself was let's go out and let's take a chance on some operators, and some of them rose to the challenge and some did not.
Right. No, that's awesome. That's a great way to look at things. And either you win or you learn. So hopefully you learn. Right. That said,
Right.
what is your economic outlook after the rate cut was done?
Yeah. So, I mean, Craig, from what my experience has been and what I've read, the literature out there, I think when interest rates historically have begun to drop, they've dropped relatively quickly. And so I'm really bullish on, multifamily real estate right now. I think now is a great time to get into it. I think we've had a couple of years now where we've struggled, and I like to use the analogy of a smiley face. I feel like we were at the bottom of the smiley face for a little while now, and now things are trending up and to the right, and we've already survived that big dip, and things are gonna trend upwards from this point forward. So I'm very excited about it. I don't think that they're really. I mean, think about if you had got into real estate, after the 2008, 2009 crash and really just gone all in. If you had the liquidity to put a significant investment behind that when prices reach their like all-time low, I feel like that's where we're at now. I feel like things are trending upwards, and I'm very bullish on real estate. I will say that I am a cost average type of buyer. I buy real estate when it's high, I buy real estate when it's low, and it all kind of dollar cost averages out over a period of time. But I think for people that have been sitting on the sidelines for a long period of time, now's the time to come in. Now's the time to be active. And I think we're going to see better returns than we have over the last couple of years moving forward. So I'm really excited about it, really bullish.
So a couple of things that we're going to take the conversation from here, and that's just the dollar cost average thing. It's the smartest way to do it. And I think a lot of investors need to just realize that, the returns that were achieved from, call it, from the exits that occurred in 2012 to roughly 2015 that showed absurd high IRRs. Well, when those deals were bought, they probably had pretty modest projections, probably what the standard market rate deal was, but it's very difficult to forecast, a certain amount of cap rate compression, or obviously the debt market maybe going gangbusters in the good direction, not the opposite direction. So just know that if you're an investor right now, it's kind of times like now you would assume from a cyclical perspective, which you alluded to, is when a lot of the juice is created. So definitely something to think about, particularly in the commercial real estate business, where the instrument for returns is really predicated upon the debt market there, and where evaluations can go. And when debt is the highest, is probably the best time to start investing. That said, you're a dollar cost average investor, and that segues perfectly probably into your tax strategy plans, which is something that you're so passionate about. So just want to preface, I am not a CPA. I am not a tax consultant. This is, and nor is Gib Irons, and you can speak that for yourself.
Nope,
But we're
nope.
just giving strategies here that you're implementing in your day to day, as I've kind of taken out and I'm able to achieve as well. But let's talk about maybe some of those tax strategies that you're looking at, and maybe why you're a dollar cost average investor due to the advantages that you've been able to achieve.
Yeah. So Craig, I have been able to save a tremendous amount of money on taxes over the past couple of years. And I think 2021 was the first year that I really did well. In 2021, I did 16 cost segregation studies. And by I mean that an engineer performed 16 cost segregation studies for me. And I think I paid about $20,000 for those cost segregation studies, and then I paid another $20,000 for my tax return to be done. And that year, I had a personal income in the seven figures, and I paid about $50,000 in tax. And so that $50,000 tax payment I was paying less tax, making over $1 million, paying less tax than I was when I was making $500,000. And so that was all from doing cost segregation studies and taking bonus depreciation. One move that I made recently, and I spoke about this last time I was on your podcast, was, and it was a ballsy move that I didn't know how it was going to turn out. Right. Candidly, I withdrew $1 million from a retirement account that I had. I had been contributing to a 401k for over a decade, and I was putting like $50,000 into my 401k every year for 10 years, maybe even a little bit longer. And those funds had grown to over $1 million. So I had a 7-figure 401k. And I decided that nobody ever becomes financially free from having like $10 million in your 401k. If you've got $10 million in your 401k, well, guess what? You can't touch that money until you're 59 and a half. And so it's not going to help you create financial freedom. It's good to have it there when you reach retirement age, right? But until then, it's just a number on a bank account statement, or on an investment account statement.
Because you're not getting dividends, you're not living off the interest of that money. It's just kind of sitting there, and obviously it's very safe. It's for a lot of people, a very tax efficient route. It's your retirement plan. It's your basically your means to end. It's your nest egg in that sense. But I think what you've learned and how you've implemented it is very unique.
Yeah, so I decided that after conferring with my CPA, who's very talented, I decided that I was going to withdraw $1 million from my retirement account and essentially liquidate the account. And so I did that on like January 1st of 2023. And, fortunately, due to a charitable giving strategy that I was able to do, I was able to make a charitable contribution and basically save a tremendous amount of money in tax. So when it came time to do my 2023 tax return, I had a bunch of bonus depreciation that I had piled up from a bunch of different multifamily investments. I had done a charitable giving strategy where you give money and then the money is used to create like a topical ointment for burn victims. And we then donate that topical ointment to a place like St. Jude's, for example, like a children's hospital. And when we did that, we got a 5X valuation on our donations. So like if you donate $100,000, you get a charitable contribution of $500,000.
Wow.
And so I was able to use those types of techniques that have been used, by the ultra wealthy for many, many years, to basically eliminate my tax burden. And at the end of the day, I'm pleased to report that even with the penalty, the 10% penalty for pulling the money out of my retirement and basically taking that's $1 million in ordinary income plus my law firm money, and I still ended up paying less than $100,000 in taxes. So it was a huge win for me. And those are the kind of things that enable you to build wealth at a much faster clip than if you were, if I had to give all that money away in taxes, then I would not be able to build my net worth nearly as fast. So now I'm basically on a trajectory, Craig, where I'm building my net worth about 2 to 3 times faster than I was previously, just based on having this knowledge and access to people in our community like yourself. I mean, this knowledge is being passed around in our community, and I implemented it, and now can raise my net worth at a much higher level than I ever could previously.
Yeah, well, thank you so much for being so transparent and open to share your story and your win and experience there. And something you just hit on there, I almost get chills thinking about. Oftentimes I get asked, what is, maybe the favorite part about my job? What is my favorite part about my career that is so special? And it's exactly the word you said, which is community and the network and the information, the ideas that are traded here. It's like everyone's in this self-development space where egos are checked at the door, where people are just trying to learn from one another and implement best practices into their life, whether it be Derek Peterson, who's in Europe, kind of having a life work balance, not a work life balance, whether it be with you with some of your creative strategies, whether it be with Chris Larson with his insurance, kind of play, life insurance policy, stuff like that. And on top of the other stuff he does, the brain trust that you get if you really kind of dive into this community is really unique. And it's just great to kind of complement this with the traditional routes. There's nothing wrong with the traditional. There's nothing wrong with
Nope.
the alt. You probably
That's
want to
right.
have exposure to both, but to kind of blend
Agreed.
everything together is, I think, where you get a lot of the magic. So thank you so much for sharing that and that strategy there. And then on to the final topic here, which is something that I think it'll be easy for you to speak on because you've really taken over this world by storm, which is the social media strategies that you've implemented, whether it be on LinkedIn, YouTube, podcasting, everywhere people know who you are. It's funny, when we were doing a deal together, many people like, oh yeah, you're doing the deal with Gib. It's like, yes, we are. So it was like, okay, hey, great, talk to Gib. That's your guy. Speak with him there. But it was so cool to hear how big, and how far your name gets out there kind of in this small little echo chamber of a space. So can you just talk about some of your strategies, what you've been able to do, and maybe your kind of plan there, and also maybe speak to some of the engagement numbers that you're getting on some of your posts?
Yeah. Yeah. So, Craig, I've worked with some very powerful people in the social media world. Like I've worked with Ryan Pineda. I've worked with a guy named Daniel Isles. And, what I've learned is that, if you want virality, one of the best things to do is to look at other things that have already gone viral. And so with social media, it's one of those rare things where if I really admire the social media work that you and Rob are doing at Lone Star, I can watch what you're doing and I can replicate your playbook. And so social media is one of the few things where I can literally look at exactly what you're doing and I can replicate it, right? And there's nothing wrong with that. Nobody's going to say,
No.
oh my God, Gib, everything you're doing looks like what Craig and Rob are doing. It looks like you ripped them off. I can take your most viral video or your most viral post on LinkedIn and I can change the wording to make it my own, to where I really have ownership of it and I'm not just ripping you off, but I can replicate that virality in the same way. And so I think that was a huge breakthrough for me. I love social media. I mean, how often are you going to get an opportunity to speak to hundreds of thousands of people at the same time, right? Like unless you're, some famous actor or sports celebrity or something like that, and you're able to speak in these massive stadiums, you're not normally going to get that many people as a captive audience. And so social media is super powerful. And after several years of just kind of doing a little bit of social media here or there, I decided to go all into it, all in with it about a year ago. And I decided to spend some money getting training from people like Ryan Pineda and Daniel Isles and just looking at other people's stuff. But, gosh, I mean, my LinkedIn, you can grow your LinkedIn by like 750 followers a month if you really work your LinkedIn. And in order to do that, you've got to have engagement. You've got to support other content creators and get them to support you. And you've got to be active in your DMs and things like that. But that's not uncommon to be able to grow your LinkedIn by 750 followers. And I work with a very good company called CRE Digital, and they've helped me with my LinkedIn, and it's just been amazing. Like those guys know my story, and they do such a good job of bringing out really important things about my story. But it's all about telling a story, right? And CRE Digital knows how to tell a story, and they know how to speak to the audience in ways that are going to help them. And so they've done a lot to help me on my LinkedIn journey. On the video platforms, look at other things that have gone viral and replicate it and grow your audience. And everybody in our community has just been super helpful to me. One thing I'm working on right now is my YouTube, and I've got somebody that's optimizing my YouTube channel and putting a banner up there and doing channel customizations. And I mean, we're already seeing a tremendous number of views compared to what we had before. So, it's kind of like the Dan Sullivan book, Who Not How. I have figured out who do I need to know to succeed on LinkedIn. And I would say that that's, CRE Digital. Who do I need to succeed on Instagram, TikTok, all the different platforms. And once you find those people, then it's really easy. So
Right.
it's all been a product of the community.
Yeah, and this just goes back to your business acumen and your ability to scale up your law firm, which is just putting systems in place. Success leaves a blueprint. That's kind of what I had takeaway there. And if you're just kind of aware and alert and want to get better, you find your coaches, you find your systems, and then you just do. And there's no substitute for the last part, which is just do, and do some more. So thank you so much for sharing that there. And just kind of the final thought is from your posting, we've kind of talked about this before, what goes viral, what works. You've basically been able to achieve a football stadium or two of, impressions on your posts. That's incredible.
Yeah, it is incredible. Like, we had a post recently that got almost 100,000 impressions just on one post. And it was on LinkedIn, and it was a really
That's
cool.
the Michigan Big House. That's the Horseshoe in Ohio State. That's a massive stadium we're talking about here.
Yeah.
That's not a rinky-dink arena.
Yeah, it was crazy because a couple of people texted me and they said, "Hey, Gib, your post is going viral on LinkedIn right now." And, it went from 10,000 to 20,000 all the way up to about 100,000 people. And it was an interesting post because it was about Mr. Beast. And, this is an interesting segue, but Mr. Beast lives here in Greenville, North Carolina, where I live. And so he's from this area, and he's a massive, social media star. And we talked about him and talked about his work ethic and how he worked, on Christmas, and he worked Thanksgiving, and he worked New Year's Day. And that's what really was the differentiator for him. It wasn't that he was like, some brilliant guy. I'm sure he is brilliant and smart, but that wasn't the thing that propelled him. The thing that propelled him was he outworked everybody else in his space. And I'm a real advocate, for hard work. I've always said, when I used to train a lot and do a lot of weightlifting, the guys used to say, the man who works the hardest gets the most. And I've always believed that, if you want to say it more gender neutral, the woman who works the hardest gets the most.
The they, them who works the hardest gets the most. Right. Yeah.
But I think that's a very true statement. And, that's what I'm all about too, man. It's about showing up and taking action and doing things, even when you're scared out of your mind to do them.
Without a doubt. And, it's just a very big takeaway I have there, which is, he's probably not the most God-gifted, talented, he just works really hard, and he had the passion and the love for it. And sometimes if you just do that enough over time, you're going to end up further than maybe the more talented person who didn't work it as hard as you. So I think that's the lesson in that story there. Gib, we could obviously talk for hours and end like we do in person, but we have to wrap it up here. Thank you so much for coming on the show. Where can people reach out and find out ways to maybe work with you, partner with you, connect with you, everything in between?
Yeah, Craig. So the best way for people to reach out to me is just to go to my website, and that is ironsequity.com, and they can reach out to me from there. I've got a calendar link. Anybody that would like to talk to me, that wants to talk real estate or whatever, can go on my website and book a call with me. And I always love talking to business owners, entrepreneurs, real estate investors. And it's always a pleasure to be on the podcast, man. I really appreciate it.
Thank you so much for coming on. And for those who have been listening, thank you so much for being here, and we will see you next week.